Welcome back to XRP Insider Network. Most people believe XRP already had its moment. They believe the big run already happened. They believe the opportunity has passed quietly and anyone still paying attention is late. That belief is exactly why this setup exists. Markets do not reward what feels obvious. They reward what is misunderstood, ignored, and quietly built while attention is pulled somewhere else. Right now, XRP is sitting in that exact zone, silent, underestimated, frustrating, and structurally misread. The largest financial moves in history never begin when excitement is high. They begin when participation is low, when conviction is thin, and when price action feels boring and discouraging. That discomfort is not accidental, it is where positioning happens. To understand why XRP is here, you have to stop looking at short term candles and start looking at structure, because XRP does not exist in isolation. We are living through a structural transition in global capital markets. This is not a normal cycle. This is not a temporary downturn. This is a rerouting of liquidity itself. Liquidity is no longer being sprayed indiscriminately across risk assets. It is being filtered, conditioned, and constrained through regulation, compliance, and institutional mandates. In environments like this, speculation gets punished, narratives decay, utility survives, infrastructure gets built quietly while attention stays focused elsewhere. This is why Ripple looks quiet on the surface. There is no constant hype, no meme driven excitement, no daily influencer parade shouting price targets. Instead, what is happening is regulatory positioning, legal clarity, infrastructure deployment, and institutional alignment behind closed doors. Silence in capital markets does not mean weakness. More often, it means control. One of the most misunderstood advantages XRP has is that Ripple operated for over a decade outside the public market pricing machine. No IPO, no quarterly earnings narratives, no retail-driven speculation cycles. Instead, Ripple grew through private funding rounds, strategic partnerships, and closed-door agreements with banks, institutions, and governments. Public markets price stories, private markets build systems. XRP has never been fully priced the way Wall Street prices assets because the underlying company has never gone through public scrutiny. You cannot price what you cannot model. You cannot model what is not disclosed, and you cannot properly value an ecosystem when the core operator has never been forced to open its books. That changes the moment Ripple enters public markets. An IPO does not just create a ticker symbol, it forces forensic analysis, revenue streams, licensing agreements, subsidiaries, regulatory posture, strategic investments, balance sheet exposure, and yes, indirect and direct relationships to XRP. That is the moment XRP stops being viewed as just another crypto asset and starts being evaluated as a strategic component of financial infrastructure. Timing matters here. Retail interprets delays as weakness. Institutions interpret delays as precision. You do not ring the bell during chaos. You wait for regulation to stabilize. You wait for liquidity conditions to improve. You wait until capital is ready to deploy with confidence and scale. That is not fear, that is control. Wall Street does not front run what it does not fully understand. It waits for structure. It waits for compliance. It waits for paperwork to be finished. Until then, price stays muted. Liquidity builds quietly. Positions are accumulated slowly, not by retail chasing green candles, but by capital that moves early and exits late. That is why XRP feels like it is lagging while other assets pump. It is not lagging, it is loading. Historically, XRP always moves later in the cycle. Bitcoin leads, Ethereum follows, broad alts rotate, then XRP absorbs liquidity from assets that already ran. When that release happens, it does not trickle, it rushes. Those moves feel sudden because pressure was stored, not because demand appeared overnight. Now consider utility, because this is where the narrative fundamentally changes. Most people still think of XRP as just a payments coin, fast transactions, low fees, cross-border transfers. That framing is incomplete. The XRP ledger is evolving into institutional grade financial infrastructure, not experimental DeFi, not yield games, not unsustainable incentive loops, real lending frameworks, fixed terms, fixed rates, risk isolation models institutions actually understand. Institutions do not chase hype. They chase predictability, compliance, and repeatable outcomes. When an asset changes category, markets are forced to reprice it, but repricing only happens after positioning is complete. Retail waits for confirmation. Institutions position before confirmation exists. That is why you see quiet inflows into XRP while other large assets experience outflows. Nobody accidentally allocates tens of millions of dollars. That is deliberate positioning. On-demand liquidity has already processed tens of billions in volume. Asia-Pacific corridors dominate. Payment routes are live. XRP is being used, not tested. That is the difference between theater and infrastructure. Global payments is measured in the hundreds of trillions. XRP does not need to dominate that market. It only needs to compound. Every new corridor, every incremental volume increase, every additional institution adds pressure to the same fixed supply asset. Infrastructure turns on quietly. Price reacts later. This phase is not about watching candles. It is about understanding structure before clarity arrives. And that brings us to regulation. For years, XRP lived under a legal cloud. That cloud was not just about Ripple, it was about whether institutions could touch the asset at all. Compliance departments do not speculate. If there is uncertainty, they walk away. That is exactly what happened. Liquidity stayed thin by design, not by accident. Now look at what changed. XRP is one of the few large digital assets with meaningful regulatory clarity in the United States. Regulatory clarity does not cause instant pumps. It causes delayed allocation. Institutions do not buy headlines. They adjust models, they update mandates, they open liquidity windows slowly. That process is methodical, deliberate, and invisible. While retail focused on frustration, infrastructure kept turning on. Corridors matured, pilots became production systems, usage persisted. Usage is the metric that does not lie over time. On-chain data shows XRP Ledger activity is dominated by payments, not speculation. That is rare in crypto. Most networks are internal transfer loops. XRP behaves like a utility network. That matters during stress. Speculative volume disappears, utility volume persists. Emerging markets play a critical role here. Adoption never starts in New York or London. It starts where friction is highest, where remittances are expensive, where currencies are unstable, where the system fails first. When countries provide legal clarity, it is not about speculation, it is about functionality. Those decisions do not move price tomorrow. They build volume over years. Markets can ignore narratives. They cannot ignore sustained flow. Flow is what forces repricing. This is why XRP feels wrong right now. Fear is high, confidence is low. But positioning tells a different story. Quiet inflows, structural upgrades, regulatory alignment, expanding real-world usage. These signals appear before repricing, not after. Most people wait for price to tell them what to think. By the time price speaks loudly, the opportunity has already narrowed. Being early always feels uncomfortable, slow, boring, doubtful. That discomfort is the cost of asymmetry. If Block 1 explained why XRP is misunderstood, Block 2 explains why that misunderstanding matters. Financial systems do not collapse overnight. They strain, they reroute, they patch, then they replace components quietly. Cross-border payments are still slow, settlement delays still create risk, liquidity inefficiencies still exist. These problems are not solved by speculation. They are solved by rails. XRP is a rail. Rails do not trend on social media. They get adopted by necessity. This brings us to supply dynamics, which most retail investors misunderstand completely. XRP does not rely on hype-driven supply shocks. It relies on functional demand. As a bridge asset, XRP cycles liquidity through itself. The more volume that moves through it, the more liquidity must remain available to support that flow. That creates baseline demand that does not care about sentiment, news cycles, or market mood. This is why XRP behaves differently during periods of stress. Speculative assets bleed. Utility assets persist. On-chain data consistently shows XRP Ledger activity is driven by payments, not trading loops. Most crypto ecosystems behave like casinos. XRP behaves like infrastructure. That difference becomes visible only during downturns. Now consider the ETF angle. ETFs are not about hype. They are about access. They allow capital that is structurally barred from holding spot crypto to gain exposure through regulated vehicles. When products tied to XRP attract allocation during broader market weakness, that is not coincidence. That is asymmetry being recognized. Institutions think in asymmetry. They ask a single question: is the downside limited relative to upside potential? XRP increasingly checks that box. Regulatory clarity, live infrastructure, institutional usage, existing corridors, global integration. Upside remains optionality. Downside is increasingly constrained. This also explains narrative fatigue. Markets are tired of empty promises, ecosystems that cannot scale, projects that break under real world use. As that fatigue grows, attention shifts away from storytelling toward assets that simply work. XRP does not need a new story, it needs the existing one to finish unfolding. Long periods of volatility compression are not a sign of failure, they are signs of energy storage. When volatility returns after compression, moves expand rapidly because positioning is uneven. XRP's liquidity profile amplifies that effect. This is why repricing events feel sudden. Pressure was already there. Most people will not believe this until price forces them to. Confirmation always arrives late. Social proof always comes after the move. By the time belief becomes common, the asymmetry is gone. The people who benefit most are not the ones calling exact dates. They are the ones who stay positioned through boredom and doubt. If this phase feels uncomfortable, that is the point. Opportunity rarely feels good in the moment. It feels slow, it feels frustrating, it feels wrong. XRP has quietly crossed from speculative debate into structural relevance. Once that line is crossed, price becomes a matter of timing, not possibility. Nothing explodes at the moment, it becomes inevitable. It explodes after inevitability is already locked in. Markets do not move when information becomes available. They move when positioning becomes unavoidable. This is XRP Insider Network. Stay patient, stay positioned.